you're watching massive stress in London. There are reports that there's genuine stress for silver, lack of silver in China, that the supply chain has completely been dried. For the first time in 50 plus years, central banks not only are buying gold, they're buying silver too. We saw Saudi central bank purchase almost 30 million worth of SLV in August. As much as I almost choke on saying that, SLV, the amount that they bought would allow them to take possession. And then you get reports that foreign investors now hold a higher amount of gold than U.S. treasuries. In fact, the share of U.S. treasuries, they were saying, was down by foreign investors from 49% to 31% today. 49% in 2013 or 2012, somewhere in that neighborhood. But in other words, at the same time all of this stuff is happening, you're beginning to see real stress within the banking system, where we've seen these two big the auto supply and the other company, I think it was called Tricolor subprime auto lender, and you know the private equity in dealing with some prime auto lenders. This company just went belly up and is tied to the regional banks. And so, I think that ultimately the markets will have their way. But again, you have a lot of very big players who are on the wrong side of this, massively short. Bob Coleman was talking the other day of the managed money being short 1 billion ounces of silver. In essence, and that's massive. It's huge. So that means that there are other players on the other side of that would benefit from it. But when you have that kind of volume on a system that is rehypothecating and trading contracts, where, for example, you look at David Jensen, who's going to come on our show. He talks about 140 million ounce float in London that's trading 600 million ounces a day in deliverable contracts, with as much as 2 billion ounces in contracts out there that could stand for delivery with only 140 million ounce float. Now, what could possibly go wrong? What could possibly go wrong? And maybe that's why Eric Young is saying that the LBMA reached out to China and said, we'll take it at these obscene rates. We need it now. We need it. And we'll pay the high lease rates because of that. Because when you play a game, and look, it's not just silver collapsing. If there was a major delivery failure by one of these banks in London, as an example, all of these banks are not just involved in bullion. They're involved in every single asset that could be traded across the globe. The systemic contagion of this would be catastrophic. It would bring down some of the biggest banks in the world. And this starts to move towards what Tom Luongo talks about, on a coordinated attack against the Bank of England and the European aristocrats. And I don't know that to be true. Tom believes it. But all I can simply tell you is that, to me, the fact that it was done the way that it is done, and then you had someone come in and scoop things up, pushing silver right back up into the positive territory, tells me it was coordinated. It was coordinated by players, perhaps, to drive the paper price down, to accumulate physical at much lower rates, to make good on short contracts that were getting very close to, creating this huge squeeze that everyone has been waiting for forever. Could it be that? Yeah, why not? Sure, there is some legitimacy to profit taking, to, look, it's gone up too far too fast, and technicals say you should take profit. Some of that is true, and I believe that to be true. But that's cover for a bigger story as far as I'm concerned. And I think that's really what I take away from all of this, honestly. And I think it's hard to ignore it any other way.
You can feel it, can't you? Something's breaking beneath the surface of the financial system. It's not subtle anymore. You can see it in the tremors running through London's bullion market, the chaos rippling through Chinese supply chains, and the sudden, almost panicked tone of central banks that used to project calm. The entire global metals market looks like a balloon that's been overinflated for decades and is finally starting to stretch thin. Let's start in London, the epicenter of the precious metals world for half a century. You're watching massive stress build there. Silver lease rates are spiking, inventories are slipping, and whispers are growing louder about physical shortages. Traders used to scoff when we said there wasn't enough real metal to cover all the paper contracts. They're not laughing anymore. When bullion banks start paying grotesquely high rates just to borrow a few million ounces, that's not a market humming along smoothly. That's triage. Meanwhile, across the world in China, the world's industrial engine is coughing. Reports are surfacing that silver supply chains have run dry, literally dry, For the first time in half a century, fabricators and manufacturers are scrambling to secure deliveries because silver isn't just a precious metal anymore. It's a critical input. It's the bloodstream of the green tech revolution. Solar panels, electric vehicles, electronics, medical gear, you name it. China's factories run on silver the way cars run on gasoline. And when those factories start hoarding, the global flow of silver stops dead. At the same time, something remarkable is happening, something that hasn't occurred in living memory. Central banks, which traditionally only hoard gold, are now buying silver. Saudi Arabia's central bank quietly accumulated tens of millions of dollars worth of silver through ETF proxies earlier this year. Say what you will about paper silver funds. The point is symbolic. When sovereign wealth funds and monetary authorities treat silver as a strategic reserve asset, the rules of the game have changed. Now add another tremor. Foreign investors are dumping U.S. treasuries. A decade ago, nearly half of all outstanding treasuries were held abroad. That figure has collapsed from roughly 49% to about 31% today. Think about that. The world's appetite for risk-free American debt is shrinking fast, while demand for physical gold and silver is exploding. This isn't coincidence, it's migration. The global financial ecosystem is shifting from trusting paper promises to demanding tangible assets. But the stress isn't confined to the metals pits. The banking system itself is cracking. We've seen mid-tier lenders collapse under subprime auto loan exposure. We've seen private equity deals unwind in sectors that were supposed to be bulletproof. It's all part of the same web. Credit markets feed the derivative markets, which feed the bullion markets. When one strand snaps, the vibration runs through the entire web. The banks that finance auto loans are often the same banks writing swaps on metals. If one blows up, the others wobble. Here's the bigger picture. This entire structure is built on leverage, rehypothecation, to use the technical term. 1 ounce of silver can be pledged, lent, and repledged dozens of times across multiple contracts. The same bar sits on 50 balance sheets. It's the financial equivalent of a shell game, and everyone pretends the ball is still under the cup. But what happens when too many players ask to see it at once? That's what we're approaching now. Bob Coleman recently pointed out that managed money accounts are effectively short roughly 1 billion ounces of silver. Let that sink in. 1 billion ounces. That's more than the world produces in an entire year. Somewhere out there, the other side of those trades is waiting to collect. And if even a fraction of those contracts demanded physical settlement, the system would seize up instantly.
Large quantities of silver are being transported out from exchange warehouses and sent to secondary silver vaults across the country, ensuring the daily silver needs of millions of industrial enterprises. At the same time, state-owned enterprises are taking advantage of the significant price pullback to actively purchase silver from international markets, ensuring the normal operation of the industrial system. China is intensifying reserves of various strategic resources and will absolutely not allow key mineral resources to flow out of the country, nor will ever compromise national interests to rescue a foreign company. Now, here's another thing. Eric Young, King Kong on Twitter, someone that I've been wanting to have you interview. I've interviewed him once before, and he's fantastic. He says, I was just told that a 150-ton lease, or 4.82 million ounces, actually was leased by the London Metals Exchange from the Shanghai Metals market, and that it was done so at grotesquely high lease rates for a very large tonnage. This would signal that borrowers who are short of deliverable metal and are willing to pay up to bridge the near-term needs in London are doing it because things are of that dire of a situation where it could really start to spiral and contagion can take effect. So again, when you see someone at this level who's been right for a very long time, and I have nothing but the highest amount of respect for him, to me, the bottom line is that the theme that we've been talking about, the tight physical, the high lease rates, the cross-region scouring for bars, this is real and well reported. And if you see 150 million tons from Chinese state banks and via the Shanghai Gold Exchange delivered to London to quell this problem, it would go hand in hand with knocking the hell out of the price by the same players to make people think the market is overvalued, that it's at its peak like it was in 1980 and 2011. And look, letting the price go up as high as it did pulled in an awful lot of speculators, and a lot of them didn't own gold; they just owned paper. And so when you dump massive waves of futures contracts into this thinly traded market, a lot of them sold without even knowing. They got triggered out of their contracts, which drove the paper price down. And maybe that's when you had London come in and say, we need to buy this silver at a lower price. Maybe it was London who came in and bought that silver after they knocked it down. I don't know who did it and who bought it. But I do know is that, to me, the whole point was to scare people away from buying gold and silver. That's what it really feels like to me. And this wasn't just another random correction. To me, it's as much as it could be as big as helping keep the LBMA propped up to maintain their system. But if there really is that much of a shortage that we've been hearing about forever, this game can't last, and supplies will keep shrinking no matter what amount of paper selling comes into the market at inopportune hours. And so I think, again, yes, it's scary to see a market move like this, but the fact that it moved like this is what, to me, makes it not so scary.
What's happening right now in the silver market is more than a financial story. It's the story of a global confidence collapse disguised as volatility. When you look closely, every shock, every flash crash, every technical correction is just the system showing its cracks. We're watching the unraveling of a paper empire that's been pretending to represent real value for half a century. And silver is now the front line of that battle. Across the Atlantic in London, the pressure is reaching a boiling point. Lease rates are soaring to levels nobody's seen in decades. Vaults that once overflowed with metal are thinning out. And the whispers among traders aren't about profits anymore. They're about survival. When a bank is willing to pay absurd rates just to borrow metal, that's not business as usual. That's desperation. It's a sign that the entire structure, the endless stacking of leveraged contracts, unallocated accounts, and synthetic derivatives, is buckling under its own weight. London is the beating heart of the global silver trade, but it's beating faster and harder every week, trying to pump metal it doesn't have through veins that are running dry. At the same time, China, the world's factory, is quietly hoarding everything that shines. They've moved beyond simply buying gold. They're stockpiling silver, copper, nickel, rare earths, the lifeblood of the industrial world. Reports of silver shipments being rerouted from exchange warehouses to state-controlled vaults aren't rumors anymore. China is locking down its strategic resources, building walls around its industrial capacity, and sending a clear message. The days of Western financial dominance are numbered. They understand that when the next global shock hits, it won't be paper promises that keep factories running. It'll be real metal. The symbolism is profound. For decades, the West treated silver like an afterthought, a mere commodity, a speculative toy. The East sees it for what it really is, money. And when state-owned enterprises in China buy aggressively into every dip, they're not reacting to market noise. They're making a statement. They're saying, we don't trust your system anymore. We'll take the metal instead. That brings us to one of the most extraordinary developments we've seen in years. The rumored lease of nearly 150 tons of silver, roughly 5 million ounces, from Shanghai to London. Think about that. For the first time in living memory, the West had to go hat in hand to the East and borrow silver and pay through the nose for it. Those lease rates weren't just high, they were grotesque. That's what happens when the market stops functioning normally. When you have to fly metal halfway across the world just to meet delivery obligations, it's like a bank rushing to cover withdrawals by borrowing cash from its rivals' vaults. It's a sign of systemic stress, not routine arbitrage. But why would China agree to lend? Because it gives them leverage, real leverage. By becoming the lender of last resort for silver, China now holds a pressure point over London and the LBMA. They can dictate terms, influence timing, and watch the West squirm. And if they ever decide to close the spigot, it's game over. The illusion of infinite supply collapses, and the world sees the truth. The vaults are nearly empty. Meanwhile, the Western media, ever loyal to the narrative, will tell you it's just profit-taking or normal volatility. They'll say it's healthy for markets to correct after big runs. Sure, except these corrections always come in the dead of night, triggered by algorithmic waves of selling that dump hundreds of millions of ounces of paper silver in seconds. That's not a free market. That's a controlled demolition. It's a way to knock prices down just long enough for the insiders to scoop up real metal at a discount. The same game we saw in gold over the last decade is now playing out in silver, but this time the stakes are higher, because this time physical supply is running out. Here's the irony. The more they smash the price, the faster the metal disappears. Every dip triggers buying from the East, from sovereign funds, from industrial giants who know they can't risk being caught short. They don't see a falling price as a warning sign. They see it as a clearance sale. And so the deeper the manipulation, the faster the shortage grows. It's the market devouring itself. Now let's talk about what happens if this house of cards collapses. Imagine the LBMA or COMEX facing a real delivery failure. A moment where someone calls their bluff and says, "We don't want cash settlement, and we want bars." What then? The entire system runs on the assumption that almost nobody will ask for actual metal. But as confidence erodes, more people are demanding delivery. If even a few percent of outstanding contracts try to stand, the vaults would be emptied overnight. The resulting panic wouldn't stop at metals. These banks are interconnected with every major market on the planet. Equities, bonds, energy, crypto, you name it. A silver delivery failure could cascade into a full-blown liquidity crisis that dwarfs 2008. And here's what makes it even more dangerous. The world's biggest banks are still massively short. The managed money category alone is short roughly 1 billion ounces of silver. That's a mind-boggling position, greater than an entire year's global production, which means if silver breaks free and starts to run, those shorts will be forced to cover into a rising market with no available metal to buy. That's not a correction, that's a detonation. The kind of move that redefines wealth overnight. You don't need to be a financial expert to see how unstable this setup is. It's like watching a skyscraper sway in the wind, knowing its foundation is built on sand. The cracks are visible to anyone willing to look, and yet the mainstream insists everything's fine. Inflation's transitory, they said. Bank failures are contained, they said. Silver's just an industrial metal. Well, sure, until the factories can't get any. Even central banks are signaling that something is wrong. They've been net buyers of gold for years, but now silver is creeping into their portfolios too. That shift is historic. It's not about diversification, it's about preparation. They're hedging against a currency system they no longer trust. When you see Saudi Arabia, China, and even smaller nations moving into silver, you know the dollar's reign as the world's sole reserve asset is nearing its end. And let's not forget the investors, the ordinary people. They're waking up faster than the analysts expected. Every time silver dips, bullion dealers can't keep up with demand. Premiums spike, delivery times lengthen, and customers start realizing that paper silver is not silver at all. It's a promise. And in an age of broken promises, that's the last thing anyone should want.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.